Let's now talk about capital structures. First, let us discuss about structures. So structures refers to arrangement of group of items which are interrelated. So in real life, we usually talk about the structure of a building, machinery, etc. So capital structures refers to the composition of capital. How much of debt, how much of equity, etc. So we all know that some debt, some equity and some loans make a capital. But if we talk about how much of debt is present in the capital, how much of equity is present in the capital, and how much of loan is present in the capital, then we say that we are talking about the capital structure. Sources of finance basically has two categories. One category is owner's funds and the next category is borrowed funds. Now, can you all tell me the examples of owner's funds? So first comes the equity share capital, second comes the preference share capital, and third comes the reserves and surplus. Similarly, borrowed funds consist of loans, debentures, public deposits. Great. Coming back to capital structure. So capital structure is usually determined by a simple formula. The formula is debt by equity. You can relate this formula to cooking. So in cooking, if you want to cook rice, you say take 2 cups of water for 1 cup of rice. And if you express it in simple terms, you say that 2:1 ratios, where 2 is for water and 1 is for rice. So if you want to compare between two separate ingredients in a bowl, you use the ratio formula. Hence, to compare debt with equity, you use the formula debt by equity. But if you want to find out the percentage of debt in the overall capital, then you use the formula debt by total capital, where total capital refers to the sum of debt, equity and loans or long-term loans put together. We've already discussed about debt and equity earlier. Now let's discuss about these more in detail. So we already know that debt behaves more like a bank loan, where you got to pay the interest periodically without fail and also ensure that you repay them without fail. But do you know that for the company, the cost of debt is very cheaper than the cost of equity? Let's find out how. The first reason is that since the interest and repayment of capital is mandatorily to be done within stipulated time, people who have invested in your company's debt fund is assured of getting returns. Even otherwise, they have all the rights to take legal actions against the company to get the money if it is not repaid within stipulated time. This assured returns puts the investors at a risk lower than the equity shareholders. So they accept lower returns than equity shareholders, though they need assured returns. You must have heard your dad talking about investing his personal savings in a bank earning 8% return, which is assured, than on investing in shares giving him more than 15% return. This is because the returns from shares are not assured. Hence, the first reason for cost of debt to be lower than the cost of equity is that the lender's risk is lower. Now let's look at the second reason as to why the cost of debt is lower than the cost of equity. The second reason they say is that the interest or cost of debt is tax deductible. What do you mean by tax deductible? The Income Tax Act usually allows a company to deduct all expenses incurred for the purpose of its business from the revenue the company is making, so that it pays taxes only on the profit. So if sales is rupees 1000 and say expenses are as follows: production expense is 400, salary is 100, rent is rupees 200, debenture interest is rupees 100, then the profit you get is 1000 minus 400 minus 100 minus 200 minus 100 of debenture interest, and you get the profit of rupees 200. So if you calculate tax on this 200, you get rupees 60 as taxes. If you deduct the 60 rupees from 200, you get a profit after tax, that is after deducting tax. So the profit after tax is 140 rupees. Now assume you don't have any debenture interest and you are opting for an equity. So in this case, let's see how the profit changes. So The revenue is rupees 1000, production expense is 400, salaries is 100, rent 200, and the profit is 300. Now calculating taxes on 300, we get 300 into 30%, 90 rupees as taxes. So if you deduct 90 from the profit of rupees 300, you get a profit after tax of rupees 210. So in this case, dividend is not allowed to be deducted as an expense like you did for interest. Hence, if you have equity shares, your P&L statement will look different and it will look like this. The revenue or sales is rupees 1000, the production expense is rupees 400, salaries is rupees 100, rent is rupees 200, and that gives you the profit of rupees 300. If you deduct taxes of rupees 90, you get a profit after tax of rupees 210. And if you go ahead and deduct the dividend of rupees 100, you get a profit after tax and dividend of rupees 110. If you compare the profits in the two situations, the profit in the situation one is rupees 30 more when you use debentures instead of equity shares. This was made possible because of the presence of debentures. So our taxation expense is reduced simply because of the choice of funds we made. We chose debentures instead of equity shares. So to sum up, cost of debt is lower because of two reasons. The first reason is that the lender's risk is lower, and so the expected returns is also lower, and that makes the cost of debt lesser. The second reason is that debenture interest is tax deductible unlike dividends, and so we end up paying lower tax and we say that cost of debt is lower. A company may not keep all debt in its capital because it has the advantages discussed above. This doesn't mean that debt is all good and equity is all bad. Even debt has to be borrowed consciously, and it has disadvantages too for the company. So the main disadvantage is that the company has to pay it no matter it makes profit or loss. Hence it is riskier for the company. And this risk we term it as financial risk. Higher use of debt increases the fixed financial charges for the company. So a financial risk is the chance that a firm would fail to meet its payment obligations. This kind of risk is not present in equity. So a company has to find out or determine the perfect mix of equity and debt where it can reap the maximum advantages present in both debt and equity, and at the same time minimize the risk present in these two instruments. So ideally, a company has to choose a mix that is beneficial to the shareholders. We are not emphasizing here on benefits to the debenture holders or lenders, because lenders or debenture holders, they come and go. But equity shareholders remain in the company as owners without expecting fixed returns or repayment.